What if a company reported a 136% surge in profit, and Wall Street still punished its stock? That's exactly what happened with Tesla, and the story behind those numbers is far more complicated and far more revealing than the headlines suggest. Tesla's latest earnings report dropped like a thunderclap across financial markets, but the market's reaction was anything but celebratory. Despite a jaw-dropping 136% increase in net profit, Tesla shares slid in after-hours trading, leaving many retail investors scratching their heads and asking the obvious question: how does a company nearly double its profits and still lose favor with the street? The answer, as always, lies in the details. Let's start with the revenue miss. Now, to be clear, this wasn't some catastrophic shortfall. Tesla's revenue came in just slightly below analyst expectations, what analysts are calling a tiny miss. But in the world of high-stakes institutional investing, tiny misses on revenue for a company priced with near perfection baked into its valuation can trigger outsized reactions. Tesla is not priced like your average automaker. It carries the premium of a technology company, an energy company, and an AI play all rolled into one. That means expectations are relentlessly high, and any deviation from the projected trajectory gets scrutinized with a magnifying glass. So what drove that extraordinary 136% profit surge? A combination of factors came together: favorably improved manufacturing efficiencies, better cost management across its production lines, and a more favorable product mix. Tesla has been aggressively working to streamline its gigafactory operations globally, and those efforts are clearly bearing fruit on the bottom line. The company's ability to extract more margin from each vehicle it produces has genuinely impressed analysts who focus on operational execution. But here's where the tension enters the picture: capital expenditure. Tesla's Capex figures came in notably high, and that is the second major reason the stock faced selling pressure. High capital expenditure signals that Tesla is spending aggressively on future infrastructure, whether that's expanding manufacturing capacity, accelerating its energy storage division, or pouring resources into its autonomous driving ambitions. Now, depending on how you view Tesla's long-term story, high Capex can be either a red flag or a green light. Bears will argue it signals cash burn and near-term pressure on free cash flow. Bulls will counter that this is exactly the kind of forward investment that separates category-defining companies from the rest of the pack. And that tension between present profits and future spending is really the heart of what makes Tesla such a uniquely divisive stock. The 136% profit increase is genuinely extraordinary. It speaks to a company that has matured significantly in its operational discipline. But the Capex overhang reminds investors that Tesla remains firmly in growth investment mode, constantly betting on itself, constantly building toward a future that hasn't fully arrived yet. There's also the broader context to consider. Tesla operates in an increasingly crowded EV landscape. Competition from Chinese manufacturers, legacy automakers accelerating their electric transitions, and pricing pressures across the industry mean that margin protection is never guaranteed. The tiny revenue miss, viewed through that competitive lens, raises quiet questions about demand elasticity and whether Tesla's pricing strategy is finding the right equilibrium in various global markets. What this earnings report ultimately reveals is a company at an inflection point, extraordinarily profitable in the present, aggressively investing in the future, and operating in a market environment that demands constant perfection to justify its valuation. Tesla delivered a profit story that most companies would dream of reporting. And yet, the market whispered its concerns through a declining stock price. Perhaps the most important question investors should be sitting with tonight isn't whether Tesla missed on revenue, it's whether the future Tesla is building with all that capital expenditure will be worth the wait.